Okay, we're on. Awesome, guys. Today we're going to talk about something really interesting, and essentially it's about charge-offs. Charge-offs can be easy and also difficult to remove. So in this video, I'm going to specifically talk about Chase and how they handle specific accounts. And according to some of my clients, Chase has been very difficult to remove. I have some information that's based upon some very credible tax attorneys that came out of two tax attorneys' mouths. They said this for themselves, and what I have to say is that what they said was true, but it also wasn't 100% true. But I can't say that they're wrong, but I will just say this: they're not wrong about the fact that Chase won't remove stuff, but they're wrong, or they didn't state about how the bureaus can remove things too. So let me go ahead and flip the camera so I can just give me 1 second. Oh crap. Let me adjust my camera and let's focus on here. Okay, so we're, Zane is one of my customers. I haven't messaged him from a while. Basically he's already in the 720s. He's been a client since 2022, I believe, and we fix his credit. We pretty much remove everything off. See, I said any negatives. He says just that Chase collection, and he says we couldn't get it off my credit report. And since I've talked to two tax attorneys who both told me that Chase does not 100%, that Chase does 100%. God, he's not writing right. Chase 100% does not remove collections reported whatsoever. They will even go to court to keep it on a customer's report. Dix, he's correct. Okay, well let's go ahead and talk about this. Okay. All right. So I believe on my channel, like if you guys just look, you'll be able to find that I have removed Chase accounts off. Let me try to uncover some case studies so we can have that data aside and we can kind of just unpack this together. Now, there's some things you should know. So let's first talk about how charge-offs become charge-offs. A charge-off is, by definition in layman's terms, is legally uncollectible, non-collectible debt. It's based upon a series of measurements and actuarial work that financial institutions and risk assessment departments use in order to predict the outcome of someone defaulting on an account. And then before that, you get into early warning systems, and they can nip your account, or maybe you just default on it. Typically you default on it. Sometimes they close accounts and then you get in debt because you're not paying them, or basically when you have not paid and you're past the collection status, which is essentially 120 days. After 120 days, you're more than serious delinquent. Then the account's going to be into a collection, but the creditor has at their discretion to write it off. And the reason why they would write it off is because they don't believe that you have the capacity or the ability to pay the debt. And so what they do is at that point they should issue you what's called a 1099-C form. And from my understanding, this form is basically the cancellation of debts. It's essentially what a creditor would send a debtor to cancel the debt, and so the lender would get a tax benefit. The benefit would be that they are writing it off on their books, so it's check marked. They're no longer receiving income, because the debt you pay the lender is their income, and all of our incomes are taxed. So that's kind of how that works. And so the burden goes from the creditor to the debtor, and now you're responsible for that tax if they sent you that letter. If they haven't, then that's another topic we can talk about, but let's kind of just focus on this. And so that's pretty much the mechanism how that works. They would write it off. they're not responsible for paying that amount. Obviously, when they sell a note to you, a note, Federal Reserve note, a line of credit, any instrument, any loan is a form of monetary, a form of value, and that constitutes as income underneath the tax code. And they're not getting that money, and they don't think that they're going to get it. So what they want to do is clear their books, okay? And they would send you that 1099-C form, and then you could fill it out. Maybe you do, maybe you don't, but it's going to be on your credit report. Now, more often than not, we are seeing that on credit reports, a charge-off is simultaneously being reported in the account status labeled collection/charge-off, and that is like an oxymoron. A debt that is charged off, written off, is not collectible. It means the debt is not collectible. And one of the provisions of settling this 1099-C would be due to the fact that the debt would fall out of the statute of limitations to collect a debt, and you have to check your state. It would be a state statute that would enforce this, and then federal statute, state of course. And from there, like let's take for New York, for example. Look at California. The statute of limitations is I think it's like 4 years in most places, and New York is different than California. Okay, some places is 6, I believe. That's a lot. 3, some places is 3. In those rural areas like Georgia and stuff might be less. So this is important because it's good to know the statute of limitations of debt collectors. So if an account by any means is being reported as a collection, you might be coming soon to pass that time of the statute of limitations running out, and then you can kind of bank on that part. So to repair credit is understanding opportunities, understanding leverage, and understanding how the laws work and how items are reported on your credit report. You would dispute them accordingly. Now, the problem with what we first said is that if an account is being reported as a charge-off, and so if the account is being reported simultaneously as a collection and a charge-off, then that is definitely a violation, and that's something that we can actually fix for you. Now, they're right. Chase may not remove those accounts off themselves, and if I do recall how we got most of those Chase accounts removed for our clients and theirs, we have a lot of case studies regarding that. I have years of footage. You can go all on my social media and find a Chase account being removed as a charge-off, and I have some case studies that I could bring soon, hopefully. Maybe when I post this video I will provide them, or as soon as within reasonable time. Now, Chase might not remove it off, but the bureaus can. So that's where your angle is. Now, if there's no violations from the creditor reporting it, perhaps there is a violation that the bureau made, but that's not really likely, and it's going to be tough to get it off. And so if you're banking on that, then you may run into a problem, and it could be difficult. Like take for instance this example. Haven't been able to get it off in a year. It's tough, very tough. We tried nearly every trick in the book. But one thing that we have not done, and but one thing that you could do that could work, it's worked for other clients. And so if that's the case, you're only left with so many other options. One of those options would be to look at the archived credit reports. Remember, most people that repair credit, they're just looking at the recent reports, meaning like 3 months, 1 month. Generally, it's the report that they pull. But you can actually contest items, how they were reported months back, years back. And the way to do this is that you would have to use what's called the Equal Credit Opportunity Act and find adverse action within the reporting. Let me explain how that would work. Essentially, like if you applied for a loan or applied for any form of credit and you were denied based upon the misreporting of your credit report, that is legally adverse action, and you've suffered some sort of damage, some denial. It affected you in an adverse way, and it goes and infringes upon your rights. You would have to prove and find violations in prior credit reports that they were that they misreported. That is the way that you would get that off. Easier said than done. It's not easy. Again, not easy, but that's why you hire me. That's just one of the things that you could do. The Equal Credit Opportunity Act is very powerful. Um, it's a very powerful maneuver. It's a very powerful strategy, but then it's a strategy, not a tactic. So if you're expecting quick results, it may not be the best option for you, but you got to weigh your pros and cons. And so the beauty about ACAT is that when it extracts the information from your credit report and aggregates data from the CDIA, CDFPB public database of consumer disputes and the internet, it will be able to find all the case studies applicable to your situation, and then it would rank it from a token from 1 to 10 on the difficulty, odds, and probability of success. And you have to go with the highest percentage of what will most likely happen. So that's basically how that works. So another thing is I want to add here is if companies are in their marketing advertising that they have removed tens of thousands of dollars off their credit report, it's actually not technically accurate. And it's a misrepresentation of what's really gone. Because you see, credit bureaus do not collect debt. And so you're not removing debt from a credit bureau, because the debt is with the creditor. But the only thing that you're doing is removing the reporting of that debt, but you're not removing the debt. Some people might think that, oh, just because they remove the collection or the charge off that the debt is still not owed, but that could actually change. Doing marketing like that, it's actually easy to misconstrue what's actually happening and think that you just don't have to pay that debt. But when the IRS sends you that 1099-C form, they actually want their money.